This video is produced by David Saber Realty Team. Many home buyers are waiting for interest rates to come down before buying their next home, but there can be a significant financial advantage to buying now if you take all factors into consideration. This will be a fairly short presentation. Our outline is, should you buy now or wait? Interest rates may not come down quickly. Our interest rate offset system, federal income tax rates, disclaimer and additional notes, tax deduction, an example, buy now or wait 2 years, and part 2 of the example, gain in equity, potential additional offsets, and then contact information to schedule your personal analysis. Should you buy now or wait for interest rates to come down? Here are some things to consider. If you buy now, potential savings may offset higher interest rates. You will build equity starting now. Tax deductions for interest, taxes, and some closing costs may offset some of the higher interest rates. Your home value increases over time, and there are currently builder incentives. If you wait, interest rates may not come down soon. Prices increase 3% or more per year, so you will be paying more. Builder incentives of up to $40,000 may go away when interest rates come down. If rates go down, intense competition for scarce homes will drive prices up, and you may see many offers on a house, driving them up even further. In the meantime, if you own a home, you're still investing in older property which may be decreasing in value and may need a lot of maintenance before you can sell it. Interest rates may not come down quickly. This is a graph of interest rates over time. Don't I know it well? I bought my home in 1981 at the peak of that curve to the left and paid 18% interest. Interest rates can be very volatile. They have systematically come down since 1981, but there's no reason to assume they may stay there or come back down to the minimum that we experienced a short time ago. Our purpose today is to present our interest rate offset calculations. The goal is to offset current higher interest rates with potential savings. First, interest is deductible on your income tax. The average savings is 22%. I'll show you that on the next slide of federal income tax rates. You avoid home cost inflation of 3% or more for every year you wait. If you wait 2 years, you're going to pay 6% more for the home. To take advantage of current builder incentives, some builders are giving up to $40,000 off the price of a new home. That will go away as interest rates come down. You can take advantage of asking the seller of a resale to buy down your interest rate so it's closer to what interest used to be. In addition, you can refinance when interest rates come down, so you're not stuck with a higher interest rate for 15 or 30 years. And some banks are offering free refinancing if interest rates come down. We can introduce you to some banks that do that. For our calculation, we will need to know what tax bracket the buyer falls into. For our illustration, we will use a single filer earning $75,000, and that comes to 20% savings on your taxes for the deductible expenses of buying a home. A couple of disclaimers. These examples are for illustration only. Your situation will be different. Please make an appointment with us to calculate your potential savings based on your own information and what you would want to buy. 3% inflation in home prices is conservative but not guaranteed. As a realtor, we have to disclose that we are not licensed accountants. We know a lot about this subject, but we encourage you to check with your accountant or trusted advisor to validate how these ideas apply to you. A couple of additional notes. We make no representation about your ability to buy a home. We can refer you to a lender who can pre-qualify you for a mortgage and provide estimates of closing costs, down payment, and other upfront costs to buy a home. Information presented here is believed to be accurate, but is not guaranteed. Interest on your mortgage, mortgage insurance premiums, and taxes on your home may be deductible on your income tax at the federal and state level. You may be able to deduct part of your closing costs the first year as well. To keep our analysis simple and applicable to all buyers, we will use the savings on the federal level only. Keep in mind you may achieve additional savings on your state taxes. For our example, we will assume a single filer with $75,000 in taxable income who is not taking the standard deduction. The tax bracket would be 22%. This person would save 22% of their mortgage interest, private mortgage insurance, and property taxes. This may come as a tax refund annually. Another option would be to adjust your tax withholding at work so that the savings show up in your paychecks. As an example, we will look at the difference between buying now or buying in 2 years. This is part 1 of our calculation on this slide. We're assuming inflation at 3% a year. So if you buy a home that is currently for sale for $400,000, that same home or one identical to it would cost you $424,000 in 2 years. So you'll be paying $24,000 more. The down payment of 5% is our assumption, which gives you a $380,000 on the home if you buy now, or a mortgage of $402,800 if you buy it in 2 years. The interest rate now, we're assuming 6.5% or 4.5% in 2 years. If you choose to do a custom calculation with us, we will use your numbers here. Monthly payment, if you buy now, $2,400 a month. That's principal and interest only. Your private mortgage insurance, taxes, and insurance would be in addition to that. If you buy in 2 years, you would pay $2,041, which would be $359 a month less. Interest over 2 years, if you buy now, would be $48,820. If you buy in 2 years, it would be $35,360. The tax savings on the interest alone, if you buy now, is $10,740, or if you buy in 2 years, $7,841. You would be able to also deduct your taxes and your private mortgage insurance, which is not calculated here, which would make it even more favorable to buying now. So your net interest cost after tax, if you buy now, $38,080. If you buy in 2 years, $27,799. So if you buy in 2 years, that'll be $10,381. hold on, we have part 2 on the next slide. Next, we need to look at how much equity are you gaining by buying now. First of all, since the house will cost $24,000 in 2 years, 2 years from now, appreciation for the house you bought, it would be $24,000. If you didn't buy it for 2 years, you have no appreciation at that point in time. That is, on the day that you eventually buy the house. You're also paying down your mortgage, which you start doing earlier if you buy it now. Over 2 years, the principal that you pay towards your mortgage would be $8,390 because you've been paying for 2 years. If you're just buying it 2 years from now, you've not paid down the mortgage at all. Total gain in equity for appreciation and paying down the mortgage is $32,390. Your net cost after tax and equity, if you buy now, $5,690 versus if you buy in 2 years, $27,990 in potential savings that you did not achieve, which is a difference of $22,110. So after all is said and done, you're better off by more than $22,000 if you buy now instead of waiting. But this isn't your savings, this is an example. Contact us, let us work through it for you and see what your savings would be. But that's not the end of the story. We know builders who are offering incentives between $10,000 and $40,000 because they need to keep moving homes to keep their companies afloat. So they're offering large incentives to buy now. Some builders are also providing interest rate buy downs for interest rates as low as 3.99%, which takes the interest rate completely out of the picture. Not all of them are that low, but many builders and some sellers are offering some interest rate buy down. We have sellers, including builders and resales, that are willing to pay up to 5% of the purchase price to pay your closing costs for you. We can always ask sellers of resales to provide price reductions of $10,000 or more. This will vary by the seller and the property, of course. Again, there are adjustable rate mortgages out there. If you're expecting mortgages to come down, you would simply refinance to the new fixed rate at the time that your adjustable rate mortgage is set to adjust. There are additional savings by such strategies as choosing a shorter term loan. We urge you to contact us so that we can provide you with a personal analysis of how this system would work for you. Thank you for listening.